Hello all my dear students, I hope you all are doing good. So today we are going to start with the CA final direct tax revisions for May 22 and November 22 attempt, and that will be in full English. Now a Hindi English revision is already uploaded by me on my channel. You can watch that if you want. But if you wish to watch your CA final revision lectures of direct tax for May 22 and November 22 completely in English, 100% in English, then you can watch this series which is going to come from today. So here I am going to try to cover the entire syllabus in few hours, so that on the day of exam, a student shouldn't have any problem regarding revising the entire subject as compared to what a student generally faces when a student study directly from ICI material. Because ICI material is in-depth, is great, the content is great, the questions are great, I agree to all of them. But practicality is you cannot revise the entire ICI material on the day of exam. So for that purpose, we have made this colored summary for you all. You can watch this colored summary. You can download this colored summary from the description box. I will put the link in the description box from where you can download this particular thing. You can take the printout. Let me tell you very clearly, we do not sell the books as of now. As of now, I don't have any plans to sell any of my books. It's only available to the students who have enrolled with me. But in case if you wish to learn from this particular book, you can download it. You can take a printout at your end. It's all your wish. And then you can follow these revision videos, no matter from wherever you have learned your direct tax subject. So there will be around 8 to 10 parts whereby the entire syllabus will be covered. Entire means entire. There is nothing which I am going to leave over here. I'll try my best to upload it as fast as possible so that you can take maximum advantage out of it. Okay. So without wasting any further time, let me tell you very clearly, for November 22, May 22, I do not have any batches in full English. I have batches in Hindi English. Regular batch is also there, fast track batch is also there, but for November 22, unfortunately, due to time constraints, I do not have a full English batch. That's the reason I'm coming up with a revision lectures for you all directly on YouTube for free. But for May 23 onwards, I'm going to start with a live virtual batch full English. Then the recordings will also be available full English for you all. So you can tell your friends also about it. Okay. So let us go ahead without wasting any further time. And today we are going to start with one of the biggest head of income under the income tax law, and that is profits and gains from business and profession. Now we all know that there are 5 heads of income under the income tax law, starting from salary, which runs from section 15 to section 17, then house property, which runs from section 22 to 27, then profits and gains from business profession, which starts from 28 and ends on 44 DB. Then comes the capital gains, which start from section 45 and ends with section 55A. Then comes the last head of income, that is IFOS, which start from section 56 and ends on section 59. Then after that, there are some clubbing provisions which come from section 60 to 64. Then comes set off and carry forward under chapter 6 of income tax law, which starts from section 70 and ends at section 80. Then comes the last part of your computation of income, that is chapter 6A, which starts from 80C and ends on 80U. So this is how the income computation is done generally by an assessor. Now we are not interested in all of them today. We are interested in business and profession. So out of 5 heads of income, how to choose which head of income I am going to cover into? How to identify which my income is going to come under which head? For that, every head's first section is important. Every head's first section will let you know the chargeability of that particular head. Whether you come in that head or not, the first section of every head will tell you. For example, the first section of salary, that is section 15, will tell you whether you come under salary or not. That is the chargeability of salary. The first section of section 15 of salary says that you will be coming under salary if you have an employer and employee relationship. Similarly, the first section of house property, that is section 22, will tell you whether you will come under house property or not. Therefore, what does section 22 states? It states 3 conditions. First, the assessee should be the owner of a building and land and appurtenant thereto. The assessee should be the owner of a building and land appurtenant thereto, and that building and land should not be used for business and profession. If you fulfill these conditions, then your income will be classified under house property. Similarly, section 45 speaks about when your income will be covered under capital gains. Similarly, section 56 tells about when your income will be covered under IFOS. Therefore, the first thing before we start with the chapter of business and profession, we need to understand when my income will be covered under business and profession. And for that, there are two kind of charging section which are given in section 28. One is the general charge, another is a special charge. First of all, we are going to see about general charge, and then later on we will see about the special charge. Let us talk about general charge first. General charge, what does it say? It comes under section 28 clause 1. What does it say? General charge says that, it says the four points in general charge. First, there has to be a profits and gains. Second, it has to be from a business or a profession. Third, it should be carried on by an assessee. Fourth, it should be carried on any time during the previous year. You have to fulfill these four conditions. There has to be a profits and gains. That profits and gains has to be from a business and profession, and that has to be carried on by assessee, and it should be carried on at any time during the previous year. Let us talk about each one of them one by one and analyze all of them one by one. The first thing which I am picking up over here is you need to do a business. Therefore, the question which will arise is, what do you mean by the term business? The term business is defined in section 2 clause 13, but in a very inclusive manner, not in an exhaustive manner, because in section 2 clause 13, business says that business includes trade, commerce, manufacture, or any kind of adventure. It does not say business means, it says business includes. Therefore, it's a very inclusive definition. It's not an exhaustive definition. We do not get a clear picture out of this definition. This definition is half-heartedly made. It's not completely made properly. Therefore, what does business mean? I don't know what is business. What does business include? I know what does business include. Business includes trade, commerce, manufacture in the nature of adventure. There has to be some kind of adventure. And literally, I'll tell you in practical life, what business is, you need to identify based on the facts and circumstances of every case. The facts and circumstances of every case will tell you what business is and what business does not include. So let us talk about some Supreme Court judgment which gives us more better definition as compared to what income tax law has to say. The Supreme Court in the case of Barendra Prasad Ray has held that business implies a systematic and organized activity by applying labor and skill with a dominant intention of earning profits. Therefore, this definition is slightly clearer as compared to what the income tax law has given. This definition tells us business implies there has to be some systematic and organized activity in the business where you apply your labor, that is your employees, hard work, where you employ your skill, that is your mind. To do what? Why the hell does a businessman does a business? To earn profits. Profit element is an important element. Application of labor and skill is an important element. Systematic application is an important element. This is the far better definition as compared to what the government of India has given in section 2 clause 13. This is far better. Now coming to profession. Now ultimately I'll let you know that what is business, what is not business. It all depends upon facts and circumstances of every case. It all depends upon that. Okay. Now, apart from business, one more thing is covered over here, and that is profession. What is profession? That is also very stupidly defined in section 2 clause 36, as you can see on the board. What is profession? Again, that is an inclusive definition. Profession includes vocation. Sir, what is vocation? Vocation means any occupation requiring skill. So profession is defined. It's a one-word definition. Profession includes vocation. And what is vocation? Vocation means any kind of occupation which requires some kind of skill. With or without degree. Degree may or may not be there. Certificate may or may not be there. Example, a chartered accountant has a skill as well as a degree. It's a professional. Whereas a doctor also has a skill and a degree. Whereas Amitabh Bachchan, whereas Rajnikant, whereas Arjun Allu, they all have skill but they don't have degree. Whereas Virat Kohli, he has skill but he doesn't have degree. Even he can be called as a professional. Because to call one person as a professional, there need not be any degree as per income tax law. It just requires a vocation which requires occupation with skill, but with degree or without degree, it doesn't matter. Skill has to be there. So again, it's very stupidly defined. No clarity in the definition of profession, unfortunately. Now, what comes under business, what does not come under business? Let us take some examples. Here, there are some High Court and Supreme Court judgments whereby we are going to clarify a few things. What comes under business, what doesn't come under business. First case, there was one assessee who was having huge land. Huge means literally huge. The land was around hundreds of acres. Now, it was not getting sold. So, what he did? He started plotting that land into small part and then he started to sell. So, he started plotting the land and then he started to sell. The moment he started to sell, he earned profit. The department said that it is PGBP. But the assessee said that it is not PGBP, it is capital gains. Now, you decide. What is it? I have a huge land, it is not getting sold, so I am dividing into small parts so that it can get sold very fast and I can take the money out of it. What is this? And this is not business and profession, this is capital gains, because the dominant intention over here is not to earn profit, but to sell the land and exit the market. There is nothing like PGBP over here. At the same time, example number 2, There was one assessee who has purchased huge land, and after purchasing huge land, he started constructing a complex on that. He started making a residential complex, commercial complex, theaters, malls, hospitals, school, colleges, every possible thing that a human being requires in its nearby vicinity. He started making that and he started selling that. Now, what is this? This is business. This is business. Why? Because this is a systematic and organized activity of applying labor and skill with a dominant intention of earning profits, and therefore it can be called as a business income and not as a capital gains income. Coming to the third one, general perception of a student. What is the general perception of a student? The general perception of a student is interest income will be coming under IFOS. This is a general perception, but which is wrong. Do you know what is written in IFOS? In section 56, the charging section of IFOS, what does it say? It says interest will come under this head if not under PGBP. It means in IFOS it is written in section 56 that interest will come under this head if not under PGBP. What does it mean? It means interest can come under IFOS and it can also come in PGBP. In fact, interest will come under IFOS if it doesn't come under PGBP. It means the priority has to be given to PGBP. Therefore, interest is a very comparative matter, which can come under PGBP also, which can come under IFOS also. For that matter, dividend is not a comparative matter. Dividend will always come under IFOS because what is written in IFOS, do you know that? For dividend income, under section 56, subsection 2, you can go through that particular section if you want. That is the reason I am giving the citation to you all. Under section 56, subsection 2, it is written, dividend income will be covered under this head, full stop. There is no comparison of PGBP. There is no reference of PGBP given for dividend income. For dividend income, it is directly written that dividend will be charged under this head. It means under any circumstance, whether dividend is earned by a small investor like me or a great or big investor or big retailer or big trader, for all of them, dividend will always be classified under IFOS. But interest is not that case. Therefore, interest is very litigative. It can come under PGBP, it can come under IFOS also. Therefore, sir, when under PGBP, when under IFOS? If the interest income is related to business, earning of that interest is related to business, then it is coming under PGBP or else IFOS. Example over here. There was one assessee who wanted a contract. So the contractor said that. So other party, the tender giver person said that if you want this contract, we don't believe you that if you take the contract, you will complete the contract on time or not, you will do it properly or not. So the other person said to me, if you want the contract, you have to make a bank guarantee of 5 crore rupees. So for that 5 crore rupees, I made a FD in SBI of 5 crore rupees from where I got some interest. So the reason for making that bank guarantee and fixed deposit was so that I can get the contract. I can give that bank guarantee to the other person so that he gives me the contract. Now the question is, what is the intention of this interest? The intention of this interest is to earn interest? No, is to get a business contract. And therefore, this interest is inextricably linked with the activity of business. Inextricably means closely linked with the activity of business. And therefore, this interest will be chargeable under what? Under PGBP, as it is not an independent investment activity. In fact, it has been done with an intention of getting a business contract to boom my business, to give benefits to my business. Therefore, this interest will be chargeable under the head PGBP. And this one, point number 3, is a very important issue from exam perspective. And I'm using some technical words over here, like you can see over here. That is, it is inextricably linked. Inextricably linked means it is closely linked. You can use such words, jargons in the exam to make your paper look better. Your paper should not be very bland. There has to be some good words in that. Some technical words in that will make you a professional. You are giving a professional exam. You're not giving a college exam. You're not becoming a BCom graduate. You're becoming a professional. Post-graduation, you are a very professional person. Therefore, your language should also be professional, especially in papers like law, papers like direct tax, indirect tax, which is law-based papers. Anyways, the fourth issue, what does it say? The fourth issue, what does it say? Listen carefully. There was an assessee who was having a huge factory. Now, there was some lockout in the factory due to employee problems. Employees were on strike on a temporary basis. So, what assessee thought? That instead of keeping the factory idle for so many days, for 2-3 months, let me give some part of the factory on rent, maybe some machinery on rent, some furniture on rent, so that I can earn some money out of it, and that can be used for the wear and tear of the machinery, for the maintenance of the machinery. So there was a lockout in the factory, and the assessee started giving what? The machinery is on rent, the furniture on rent, and for that purpose, the assessee got some rent. Now, what this income will be called as? Under which head? The Supreme Court in the case of Lakshmi Silk Mills Limited in 1952 has held that the dominant purpose over here The dominant purpose of a facility in a business. If I own a business, what is the objective of those assets? The objective of those assets is to give me revenue. The dominant purpose of those assets is to give me revenue, to give revenue to the owner who has employed you. Now, if that asset cannot give you revenue directly through its business, and if you apply your business mind, which is called as business expediency, you can see over here the technical term, and you temporarily let out that to earn some revenue, that income will also be classified as a business income. That will also be classified as a business income, and it will be chargeable under the head PGBP. So therefore, if you can identify out of these 4 examples, these are just 4 examples. There are thousands of examples like this in practical life. But these are just 4 examples to tell you how complicated the question is, what comes under PGBP and what does not come under PGBP. How complicated this question is. Because, and this has all happened because of who? Because of the government of India. Because they are not ready to define the term business clearly. They are not ready to exhaustively define the term business. They are just giving an inclusive definition of the term business. Anyways, let us go ahead. Now, where does the rental income classify? Generally, if I ask you where does the rental income classify, you will say income from house property. It's not always correct. Now, in this case, in Chennai Properties and Investment Limited 2015 and Rayala Corporation 2016, what has happened? There was an SSC in the state of Tamil Nadu, in Chennai. The main objective of the SSC was to acquire property and let out. And it was written in the memorandum. Listen carefully, each and every condition. My revision videos are the most comprehensive one in the entire nation, let me tell you. I try to cover the minute details in the revision videos. And regular batch, I try to explain each and everything from practical perspective, and then I get into the academic point. And then I try to sum up that how the entire subject has to be revised a day before exam through summary book. In regular batch, I do not directly teach from this book. I teach from a detailed textbook, whereby you will get bare act, you will get detailed analysis, you will get each and every illustration, and then we come to this particular book to compact the entire thing, and then so that how to revise on the day of exam. So let us come to the discussion. Chennai Properties and Investment Limited, a Supreme Court judgment, a landmark judgment of 2015. What has happened in this case? The assessee was engaged in condition number 1, acquiring property in the state of Tamil Nadu, that is especially in the city of Chennai, and then letting out. That was the main object. That main object was also written in the memorandum of association of the assessee, that the main object of the assessee is to acquire and let out. And third one, the substantial income of the assessee was from let out. Substantial income was from let out. I am not saying entire income, but substantial income from let out. The Supreme Court held that in that case, the income will be held under the head PGBP and not under the head house property. This income will be charged under the head PGBP and not under the head house property. Such a big decision was made by the Supreme Court in 2015. Therefore, there is a very thin line of difference between where the rental income will be classified. Will it be classified under PGBP or house property? In this case, if these conditions are fulfilled, which I have said you, the main object, the substantial income was to acquire, memorandum of association, if these conditions are fulfilled, it will be classified under PGBP and not under HP. Similar case was given in the case of Rayala Corporation. The SSC has stopped its other business activity, and the only business which was left with the SSC was to lease the property and earn rent from therefrom, and therefore that income was also classified under the head PGBP. Now, as against that, suppose I am Lodha Builder. Okay, Lodha Builder. What is the objective of Lodha Builder? Lodha Builder's objective is to build the property, is to construct the property and then sell. Now, suppose that Lodha has built a property of 100 floors. He has completed the construction. Now, 50 floors are sold, 50 floors are unsold. Now, he is letting out the unsold floors. He is getting some rent. Where the rent will go? Now, that rent cannot go in PGBP. That will go in HP. The reason being, the main objective of Lodha is not to construct property and let out. The main objective of Lodha is to construct property and sell. Lodha cannot take the benefit of this particular Supreme Court judgment. If Lodha let out its unsold property for a temporary period to earn some revenue out of it, then that income cannot be classified under the head PGBP. That will be classified under the head house property, because the main objective of Lodha is not to construct and let out. Its main objective is to construct and sell the property. Okay. So this is what the term business and profession is very widely confused by the government of India. What comes under business, what comes under profession, what does not come under business, what does not come under profession is a matter of great discussion. And because it is not properly defined, the burden is on whom? Is on the judiciary. Is on the high courts, is on the Supreme Court of India. Okay. Now the second part of the business and profession. The second part of the charging section was the profits and gains. Because the entire sentence of section 28 clause 1, the general charge says that profits and gains from business and profession. So now the question is, what do you mean by the term profits and gains? So under section 28.1, what is covered is only revenue profit, not capital profits. Capital receipts are not covered in 28.1. Okay, only revenue profits are covered. If the government wishes to charge capital profits, they have to make separate charging section. They have to make separate charging section. Okay. Second, profits and gains may be legal or from illegal business. It doesn't matter. Even if you sell arms and ammunition, and if the government catches you, then the government will charge tax on you on the PGBP. Profits and gains may be in cash or may be in kind. Profits and gains must be from real profits. If you want to charge your profits and gains under section 28 clause 1, your profit has to be real profit. It should not be notional. It should not be anticipated. It should not be deemed. If you wish to charge a notional profit, an anticipated profit, a deemed profit, you have to make a separate section for that. The way the government has made 44AD, 44ADA, 44AE and many other sections. The government has made a separate section. 44AD, 8% of turnover, a separate section is made. 44ADA, 50% of gross receipt, a separate section. So that is what, in those sections, what is happening? In those sections, a notional income is getting charged of the assessee and not the actual income. I hope you are clear with this. Therefore, profits and gains are supposed to be real, are supposed to be revenue, are supposed to be legal, illegal, both, are supposed to be cash in kind. It doesn't matter. Okay. Third point, profits and gains from business and profession. Now, who will carry on the business? It should be carried on by the assessee. Is it necessary that all the activities of the business should be carried on by the assessee? Not necessary. Carried on by the assessee means the business should be in the control of assessee. It does not mean that the actual conduct of business should be done by the assessee. It does not mean that. It only means that the business should be controlled by the assessee. It means that business should be, all the major decisions should be made by the assessee. The investment should be made by the assessee. That is what carried on by the assessee means. Carried on by the assessee doesn't mean that you go to the shop and open the shutter. Carried on by the assessee doesn't mean that you will clean the door also, you will clean the floor also. It doesn't mean that. It means you should control the business. And the last part of the charging section is you should carry on the business at any time during the previous year. It is not necessary that the business should be carried on for the entire year. It is not necessary. You can carry on the business for a particular period of a year, not for the entire year. It doesn't matter. Okay? Now, after we are done with the charging section, the next question which will arise was how to compute PGBP income. So that answer is given in section 29. And section 29 very clearly says that in a very simple line, that to compute PGBP income, you have to follow section 30 to 43D. You follow 30 to 43D and you will be able to compute PGBP income. But before that, you also have to make a books of accounts. So how to make a books of accounts and which accounting method to follow under income tax law? About that, it is given in section 145. And in 145, there are 3 subsections which talks about that. The first subsection, 145 subsection 1 says that if an assessee is having an income under PGBP or IFOS, then they have 2 options. Either follow mercantile or cash system, but follow regularly. You cannot switch on a regular basis. Either follow mercantile for a regular basis or follow cash for a regular basis. Now, subsection 2 says what? If you are following mercantile system, then there has to be some accounting standards. So what should be the accounting standards? The accounting standard should be the one which is notified by the Government of India. Now, what is notified by the Government of India? What is notified by the Government of India is ICDS. So you have to follow the accounting standards as per ICDS if you are following mercantile system. Subsection 3 says that. Subsection 3 says that if you do not follow subsection 1 and subsection 2, then the AO, that is the assessing officer, will do a best judgment against you. Not the normal assessment, but the best judgment assessment against you. About this, we will learn later on in a great detail when we will talk about the best judgment assessment. Okay. So these are the 3 subsections which talks about maintenance of books of accounts and the ICDS implications, right? Now, there is a master chart which is there in front of you which talks about deduction. Deduction. This is what the most of the PGBP is all about. That is section 30 to 37. And then later on some more part is there which is talking about allowances, disallowances and some deemed income and some presumptive income, but that is a smaller part. The bigger part of business and profession is this. We need to learn all the deductions one by one. Now all the deductions are categorized into 2 parts. Section 30 to 36 and 37. What is the difference? We need to understand the difference first. Then only we can go ahead. What is section 30 to 36? 30 to 36 talks about specific deductions and 37.1 talks about general deduction. Specific means for which there is a name. Depreciation, rent, bad debts. There is a name for every deduction. 37, whatever doesn't come over here will come under 37. Okay, in specific also there are 2 types of deduction. One which is available to all assessee and one which is available to certain sectors. Available to all means? Available to means all business and professions can claim those deductions. And sector wise means only specific sector. If you are a telecom sector, then only you will get deduction of 35 ABB and 35 ABA. If you are hospital sector, then only you will get deduction of 35 AD. If you are tea, coffee, rubber sector, then only you will get deduction of 33 AB. So these are sector wise deductions. These are. And this was one of the major problem for you all in IPCC. And even in CA final, if you have not learned properly. If you have learned properly, then this is not a big thing. Okay. So we will talk about all of them one by one. But before that, I will also speak today, first of all, about I'll go in the order of the book, the special charging section. At the beginning, I told you there are two types of charging section under PGBP. One is general charge, one is special charge. General charge, profits and gains from business and profession carried on by assessee at any time during the previous year. Special charge, what does it cover? There are a lot of small sections. First one, if you get any money in a non-compete agreement to not do any activity in relation to any business and profession, then that income is also chargeable under PGBP. For example, in 2003, Mukesh Ambani gave 5,000 crore to Anil Ambani to not into certain business. So Mukesh Ambani paid 5,000 to Anil Ambani for a non-compete agreement and told you will not enter this business and you take 5,000 crore. Anil Ambani took 5,000 crore. Now that 5,000 crore is taken for the purpose of what? Not entering into any business which the other competitor is going to do, and therefore that money is also chargeable under section 28(5)(a) as a special charging section. It cannot get covered in the normal charge because what is covered in normal charge is only revenue receipts, and this is the capital receipt. So if the government wishes to charge a capital receipt, then they have to make a special charging section because it cannot get covered in the general charge. I hope it is clear. Plus, here one more procedure and one more formality which the government has put on the assessee, and that is Mukesh Ambani, while making the payment or making the credit of that 5,000 crore rupees to Anil Ambani, will deduct TDS under 194J at the rate of 10%. 194J cover this particular thing. Whenever we will do the discussion of the great topic of TDS, we'll talk about this aspect as well. You just remember the clause 28(5)(a). Okay. Let us go ahead. Second one. In business, if you get any benefit or perquisites, suppose you have made your customers very happy with the product which you have made. The customer have given you some gifts or perquisites. The customer has said you, I am giving you a trip to Europe worth 10 lakh rupees. Why? Because he is happy with your business. So that customer gave you 10 lakh rupees worth Europe trip, and that particular trip will be chargeable under the head PG. For example, by listening to my revision videos, suppose you are getting benefited. Suppose I am not sure that you will be, but in case you are benefited and you have got rank or you have passed with very good marks in direct tax, so you are very happy. So you came to my place in Mumbai and you came to me and you gifted me a Rolex example. So that Rolex will be chargeable to me under the head PGBP because that Rolex will be benefited from what? Business and profession. That is not out of personal affection. That is out of business and profession. Okay. This is just an example. Next, what is the treatment of life insurance? If I get an amount on maturity or if I get an amount on death benefit, is it taxable or exempt? It is exempt subject to some conditions. What are those conditions? Condition number 1. If the policy is issued between 1/4/2003 to 31st March 2012, then your annual premium should not exceed 20% of sum assured. If it exceeds 20% of sum assured, then it is taxable. It should be less than equal to 20% of sum assured, then it is exempt. Second, if your policy is issued between 1/4/2012 to 31st March 2030, this 1 year, then your annual premium should be less than equal to 10% of sum assured. It should not exceed 10% of sum assured. So in the question, you have to see when the policy was issued. At the same time, you also have to see the percentage of sum assured. Two conditions you have to see. Now, there is one more condition which you have to see in case of ULIPs, unit link insurance plan. There is one more condition which you have to see to get the exemption, which we will see in the chapter of capital gains. So for ULIPs, there are 3 conditions, but other than ULIP, there are only 2 conditions. That is, the period has to be seen and the percentage has to be seen. Now, if the policy is issued after 1/4/2030, then there are 2 percentages which are given by the government. For normal assessee, it is up to 10%, is all fine. But for disabled person, it is up to 15%, is all fine. Okay. If the percentages crosses these limits, then this exemption will not be available. It will be taxable in your hand. Okay. Now for ULIP, you need to see one more condition. Let me tell you very clearly, this is not complete, which we'll see in the chapter of capital gains, because there is an implication of capital gains under section 45. There is some taxability under capital gains, which cannot be done under the head PGPP. That is the reason we have kept that discussion with capital gains only. Now, what is the taxability of keyman insurance policy then? Is keyman insurance policy maturity amount also exempt? No, it is taxable. Now, it is taxable under which head? If it is received by employer, then PGPP. If it is received by employee, then salary. If it is received by the nominee of the employee, then IFRS. So, the mention of keyman insurance policy, the taxability of keyman insurance policy is spread under 3 heads. It can be charged under PGPP also, IFRS also, salary also. Next 3 points under section 28 are related to export assessees. Their 3 incomes will be getting charged under section 28. Now, all these incomes will be very helpful for you while computing the total income question. If you find these income in the credit side of the P&L in the total income, let it be, because these are chargeable as PGPP. If you do not find them on the credit side of the P&L, and if you find them in the adjustment, add to profits. You should add that to profits, because these are PGPP incomes. Therefore, export related assessees will be charged under 3 different criteria. First, if you have got an import license from government, and if you do not need that import license, and if you are selling that license, and if you are getting profits out of it, it is chargeable under the head PGPP. Profit on sale of import entitlement license is chargeable. Second, if you are getting some duty drawback under customs, then that is also chargeable under PGPP. Third, If you are doing some export, doing export is great for country. Government should give some kind of benefits to you for doing exports. So if you are doing some exports, exporters will always be kept at a priority as compared to non-exporters by the government of India, because exporters bring foreign currency in India. So if you are exporting something, and for exporting that, government is giving you some cash assistance, that cash assistance is also chargeable under the head PGBP. So duty drawback is chargeable, profit on sale of import license is chargeable, and cash assistance against export is also chargeable under the head PGBP. Okay. One last thing. If you have entered into a business contract with someone and the other party is terminating the contract or is modifying the contract, and for that he is giving you compensation. So if there is a business contract which is terminated or modified and you have received compensation in relation to that, then that is also chargeable under business and profession. But only if a business contract is terminated, because what is written over here is only business, not profession. If a profession contract is terminated and the money is received for that, or if a professional contract is modified and if money is received with that, then that is not covered over here. As of now, that cannot be charged under the head PG. Okay, be very clear about it. So now we are going to start with one by one all the deductions, and out of all of them, we'll complete all of them one by one now. Now, any guess what we are going to start first? The first deduction which we are going to start is the biggest out of all of them, and that is depreciation. Let us talk about depreciation in today's session first of all. I will not be able to complete the entire business and profession revision in one revision videos. That is practically not possible for me. Please forgive me, okay? That is not practically possible, and that is not practically possible for you all to revise for 5 hours or 3 hours or 2 hours one particular chapter. Yeah. So let us start with the first one, the first deduction, the big one, the biggest out of all, and that is depreciation. There are 4 kinds of depreciation. Let me tell you first of all. The 4 kinds of depreciation which you can see on the board is as follows. The first one is the normal depreciation under section 32, subsection 1, clause 2. The second one is the additional depreciation under section 32, subsection 1, clause 2A. The third one and the fourth one is with respect to power generating assessees, and it is not available to all of them. So the third and the fourth one we'll talk sometime later. This also after some time. The first one which we are going to talk today, and the maximum depreciation which is there, the at least 90% content which is there under depreciation is with perspective of the normal depreciation only. This is a matter of 5%. This is a matter of 5%. Okay. So 90% discussion is with respect to normal depreciation only. So focus on that particular part more, because that is the bigger part in the discussion of depreciation. Now, 32 subsection 1 clause 2, which talks about normal depreciation. To claim normal depreciation, you have to fulfill a lot of conditions. One of the first condition is you need to be the owner of the asset. The assessee has to be the owner of the asset. So now the question is the term asset defined under income tax law? And unfortunately, the term asset is not defined under the term, is the term owner defined under income tax law? And unfortunately, the term ownership is not defined under income tax law. And therefore, we have to take the reference, the support of the Supreme Court judgment. The Supreme Court in the case of Mysore Minerals Limited, a landmark judgment. It's not a small judgment. It's a landmark judgment. The Supreme Court in the case of Mysore Minerals Limited held that the term owner means beneficial owner and not legal owner. What is relevant is the beneficial rights and not the legal rights. Therefore, registration, title, all of them are irrelevant to determine ownership. Okay, first thing. Therefore, there are a few more questions which will arise. First, in case of lease transaction, who will be the owner? In case of lease transaction, as per the CBDT circular which was issued in 2001, 9/2001, in case of lease transaction, the lessor will be the one who gives on lease. The lessor will be eligible to claim depreciation. Okay, he will be the owner. In case of hire purchase transaction, who will be the owner? It was again held by CBDT in around 1943, around 70 years back. That, in fact, 80 years back, not 70 also. So in 1943, CBDT has said that in case of hire purchase transaction, it is the hire purchaser, that is the buyer, who will be eligible to claim depreciation. Okay. So in case of lease, who is claiming? The lessor. In case of hire purchaser, the lessee, you can say. The hire purchaser is claiming. But this is if nothing is mentioned in the question. If there are certain facts and circumstances which are given, then this decision can also change. Okay. For that, I'll let you explain. I'll explain you through a Supreme Court judgment of ICDS Limited. Okay. Now, in this judgment, what has happened? Assessee was engaged in car leasing for a long purpose. So I'll give you a car on lease for say 3 years, 5 years. So in that case, what does the Motor Vehicle Act has to say? The Motor Vehicle Act says that when a person gives a car on lease to someone for a long-term basis, the car should be in the name of the customer and not in the name of the lessor. So the car is in the name of the customer. So I am a leasing company. I'll buy a car. Customer will order a car for a lease for 5 years. So according to the customer's requirement, I'll buy a car of that brand. The customer said me, buy a Toyota car. So I bought a Toyota car. I named that in the name of the customer because I have to do that as per Motor Vehicle Act. And I gave the car and my lease rental started. And then I claim the depreciation. The assessing officer said that you cannot claim depreciation because you are not using the car. You are not having the steering in your hand. The steering is in the customer's hand. Secondly, the assessing officer is saying, I will not give you depreciation because in the registration certificate, in the RC book, your name is not there. It is the customer's name who is there. Therefore, I asked a very simple question to the assessing officer. And even Supreme Court asked the same question to the assessing officer. What do you mean by the term owner and what do you mean by the term use? The term owner means beneficial owner. Am I the beneficial owner? The answer is yes. Am I taking the benefit out of that car? The answer is yes. What kind of benefit? I am earning money out of it. That is the biggest benefit for me. Secondly, am I using the car in the course of the business? It is not necessary that the steering should be in your hand. The asset should be used for the business and profession. It means the asset should generate revenue for business. Is the asset used for in the course of the business? The answer is yes. Further, when the Supreme Court went through the lease agreement between the lessor and the lessee, it was very clearly written that the lessor is the owner. It was very clearly written that after 5 years, the lessee will return back. And it was very clearly written that the lessee will not claim depreciation. Now, these are the sufficient evidence to tell you that the lessor will claim depreciation in this case. And therefore, this issue is also so complicated as you can see from this particular case law. It is complicated one. It's not very straightforward. Now, the second condition to claim depreciation is that you should use the asset. Use means what? Use means active as well as passive use. Passive use means something which is ready for use. That can be called as passive use. Suppose you are keeping extra assets for the purpose of emergency, then that can also be called as passive use and you can claim depreciation on passive used asset also. Now, suppose if I bought an asset and I am not able to use that asset because of some extraordinary reason. Say maybe a paucity of raw material, that is shortage of raw material in the market. I bought the asset. I bought a plant and machinery and now I'm not able to use that asset because of the shortage of raw material. Will I be able to claim depreciation? The answer is yes, as per the High Court judgment. Chennai High Court has given a judgment in the favor of the assessee and said that if you cannot put to use the asset due to some extraordinary reason, mainly because of shortage of raw material, then you can claim depreciation on that. Okay. So to claim depreciation, you need to be the owner. To claim depreciation, you need to use the asset. Now, under income tax law, under section 32, subsection 1, clause 2, you get the depreciation on block, not on single asset. You do not get depreciation on a single asset, but you get on a block of asset. So what is a block? The term block is defined under section 2, clause 11 as what? Further, there are two categories in block. One is tangible block, one is intangible block. And intangible, there are further categories: plant, machinery, furniture, building. So now you will compute depreciation based on a block, not on a single asset. All plant and machinery will be together, all furniture will be together, all building will be together, all intangible assets will be together, which are having similar rates. So intangible assets are depreciated at 25%. Now, Finance Act 2021 has said that intangible assets can include patent, copyright, trademark, license, franchise, or any other business or commercial right, but intangible asset will not include goodwill of business and profession from this year onwards. From Finance Act 2021, and that is it is retrospective by 1 year. That it is not applicable from 2020-21. From financial year 2020-21, goodwill, you are not going to get any depreciation on goodwill. We will be having a detailed discussion on this sometime later. Okay, don't worry about it. So you will not get any depreciation on goodwill. Be very clear about it. Rest all assets will be subject to 25% depreciation. Plant 15%, machinery 15%, furniture 10%, building 10%. Yes, if the asset is acquired in this year, in the current year, and it is put to use for less than 180 days in the current year itself, then the depreciation will become half. So listen to my words carefully and see this particular proviso very carefully. If an asset is acquired in current year, that is 21-22 previous year, and in this year it is put to use for less than 180 days, then the depreciation will become half. Suppose if an asset is acquired in the current year and it is not put to use in the current year, it is put to use in the next year, and in the next year it is put to use for less than 180 days, then in the next year it will not become half, it will be full. Be very careful, because the proviso of 50% is only applicable to the year in which you acquire. It is not applicable to subsequent years. I hope it is clear to you. So if you acquire, say in the month of March, 25th March, and you have not used in the current year, and in the next year, if you put to use for say less than 180 days, in the next year will get full depreciation. Be very careful about it. Now, are these the final rates? No, there are multiple rates. Example, building by default is 10%, but if it is a residential building, it is 5%. If it is temporary structure, then it is 40%. Motor vehicle by default, it is 15% because motor vehicle is classified as plant and machinery. It is 15%. But if a motor vehicle is in the business of running them on hire, then it is 30%. In that also, all motor vehicle, if it is purchased between 23rd of August 2019 to 31st of March 2020 and it is put to use in that period, if it is purchased between that period and put to use between that period, then you will get 15% extra depreciation. That is, the normal motor vehicle will get 15 plus 15, and the motor vehicle which is run in the business of running them on hire will get 30 plus 15. That is 45%. That's great. Computer is a plant and machinery, which will get depreciation of 40%. Mobile EPBX is not a plant and machinery, therefore it's a plant and machinery, but it is not a computer. Therefore, it will get a depreciation of 15%. Windmill, professional books, aircraft, pollution control equipment, all of them are plant and machinery. Therefore, it will get depreciation of 40% over here, higher rate, not normal 15%. Ships will also get depreciation of 20%. So you have to keep these rates in your mind. Sometime ICAI will test you on these rates in the exam. So you have to be very careful and you have to be very particular about these rates. Here, there is margin of error. The margin of error over here is 0%. You cannot write a wrong rate in exam. The entire solution will go wrong. Okay. Now, in the block, there are 4 assets. That is plant, machinery, furniture, building. But out of 4 assets, the government has given meaning of only 1 asset. That is plant. Building is not defined, furniture is not defined, machinery is not defined, but plant is defined. Plant is defined as what? Plant is defined as plant includes few things and plant excludes few things. What does plant include? Plant includes ships, vehicles, books, scientific apparatus, and surgical equipments. And what does plant excludes? That is more important for us. Plant excludes tea bushes. Why? Because tea bushes are already covered in 33AB. Plant excludes livestock. Why? Because livestock is already covered in 3616. Plant excludes furniture and fitting and building. Why? Because you cannot treat a furniture and fitting and building as plant and start to claim 15% depreciation on furniture. Because you cannot treat furniture or building as plant and start to claim 15% depreciation and also additional depreciation, and by saying that your furniture and building is a plant. So give me normal depreciation of 15% and additional depreciation of 20%. You cannot get that. Forget about that. I have explained you in great detail in the class about the logic of this particular thing, why this particular thing has been removed. I do not have much time over here to explain because that will take a lot of time for me to explain. Next, for claiming depreciation under block, you need to fulfill 2 conditions. First, your block must be positive on the last day of the previous year and your block must not cease to exist. There has to be at least 1 quantity in the block of asset and the amount column has to be positive. The amount column has to be positive and the quantity column should have at least 1 asset. Then only you will get depreciation. If either of the conditions are not fulfilled, then you will be chargeable with short-term capital gains as per block of asset. If the block becomes negative or if the blocks become 0, then you will be chargeable to capital gains under section 15. Is it mandatory to claim depreciation? Yes, it is mandatory to claim depreciation as per the income tax. You have to claim depreciation. There is no option available with you. There is no option. Okay. Now, next, under section 32, subsection 1, clause 2, we will get depreciation on block, on WDV. So, under income tax law, follow WDV method, except 2 cases which I have told you. For SLM basis on power generating business will get SLM depreciation. Otherwise, income tax law gives depreciation on what basis? On WDV basis also. It doesn't give you depreciation on SLM. I am getting depreciation on my mobile phone. Yes, I am getting. On what basis? On WDV. I am getting depreciation on my laptop, camera, etc., AC, whatever it is there in my studio. On what basis? On WDV basis, not on SLM basis. So, what is WDV? That also has to be defined because the charge of depreciation, the rate of depreciation, whatever you have learned over here, normal rate, multiple rates, special rates, whatever you have learned, the charge of depreciation is on WDV. So, what is WDV then? What exactly WDV means? WDV is defined in section 43(6) as WDV means actual cost of asset as reduced by depreciation actually allowed. So, actual cost, take the actual cost of the asset and then reduce the depreciation which is actually allowed to the assessee. Actually allowed means the depreciation which has been allowed to compute the PGBP income in the current year. That is actually allowed. So, reduce that much depreciation, you will get WDV. But there are 2 exceptions to this, whereby the depreciation is not actually allowed to the assessee. Still, it is reduced from the block of asset. What are those 2 exceptions? First, the unabsorbed depreciation, which is carried forward to the subsequent year, is not allowed in the current year. Is not allowed. That is the reason the name itself tells you that it is unabsorbed depreciation. The unabsorbed depreciation is not actually allowed in the current year because it will be allowed in the future year. That is the reason you are carrying forward that to future years. But still, it is reduced from the block of asset for the purpose of income tax law. You can see exception number 1 as per explanation 3 to section 43(6). Second exception. If you are earning income partially from agriculture income and partially from business income, like you are engaged into business of growing and manufacturing tea in India, you are growing tea, you are manufacturing tea, you are doing both. In that case, the business income is 40% taxable, 60% exempt. You might have done in IPCC in Rule 8. You will also do this in CA final in the next topic. That is when you do the sector-wise deductions of section 33AB. So, if your business is partially agriculture, partially business, then your 40% is taxable, 60% is exempt. But while computing PGBP income and while computing the block of asset, you will reduce the entire depreciation from the block of asset. This is what the explanation 2, exception 2 has to say in explanation 7 to section 43(6). So entire depreciation has to be reduced from block of asset. This is a very important exception. It has come in examination a lot of time. You have to be very careful about it. So you cannot segregate the depreciation also into two parts. That 40% is going towards business income, 60% is going towards agriculture income. So we will reduce only 40% from the block. The government says that you have to reduce the entire 100% depreciation from the block. You cannot segregate the depreciation into two parts and reduce only the taxable portion. You have to reduce the entire part. So these are the two exceptions whereby the depreciation is not actually allowed to you, but still it is reduced from the block. Now, one amendment made by Finance Act 2021, that is from 1st April 2020, that is from previous year 2021, goodwill is not allowed as depreciation. Now, I agree. If I purchase a new goodwill now, I will not get the depreciation. But what about the goodwill which is already existing in my existing block of intangible assets? What has to be done for that? So, government has said very clearly, if you have purchased a goodwill say in 2015, and if it is lying in 2020-21, you have to reduce it from the block. Reduce it from the block. The remaining WDV has to be reduced. It has to be reduced from the block of asset on 1st of April 2020. It is very clear. The government is very clear about the stand with goodwill. You will not get the depreciation of goodwill from 2021. If you purchase a new goodwill, not allowed. If an old goodwill is lying in the block of asset, reduce from the block. Okay. Now coming to the additional depreciation. Section 32, subsection 1, clause 2A. What does it has to say? You will get additional 20% depreciation. Why? And to whom? You should be a manufacturer, or you should be engaged in the business of power generator, distributor, transmitter, whatever it is. And you should acquire and put to use a new plant and machinery. So if you are a manufacturer, you are a power generator, distributor, you acquire a new plant and machinery and put to use, will get 20% additional depreciation for that year. You will not get 20% every year, only for that year. Sir, if I acquire and put to use for less than 180 days, then you will get 10% in this year, 10% in the next year. Don't worry about it. Sir, will I get normal depreciation? Definitely yes. This is additional over and above the normal. So if you acquire and put to use a normal asset, being a manufacturer or power generator distributor, you will get 15% normal depreciation on plant and machinery and 20% additional. If you acquire and put to use for less than 180 days, normal depreciation will be 7.5%, additional depreciation will be 10%, and balance additional depreciation will be allowed in the next year. Sir, what kind of machinery I should buy? You should buy a new machinery. Second-hand machinery not allowed. Machinery which is kept in office not allowed. Machinery which is kept in guest house not allowed. Ship is not allowed. Aircraft is not allowed. Road transport vehicle is not allowed. And last but not least, a vehicle which is already allowed as deduction in some other section, that is also not allowed. Maybe you have already taken a deduction under section 35 in the form of scientific research. Or for that matter, you have already taken a deduction under section 35 AD as your 35 AD as production of fertilizer business. So you cannot get additional depreciation on that amount. Okay. Sir, will additional depreciation will also be reduced from the block of asset? Yes, it will be reduced from the block of asset. Just like normal depreciation, what is WDV? WDV means actual cost minus depreciation actually allowed. So when I say depreciation actually allowed, you have to reduce normal as well as additional depreciation to arrive at the WDV of the asset. Sir, will the assessee engage in the business of printing will get the benefit of this depreciation? The answer is yes. CBDT has clarified that an assessee engage in the business of printing or an assessee engage in the business of printing and publishing both will get the benefit under this section. But if an assessee who has engaged only in the business of publishing will not get the benefit of this particular section, because the government has said the assessee should be either engaged in printing or printing and publishing both. Only publishing will not get the benefit of this section. Okay? Is it clear to all of you? Now let us go ahead towards the next part, and that is a big part, that is the meaning of the term actual cost. Now we have learned sometime before that as per section 43.6, WDV means what? Actual cost minus depreciation actually allowed. So now the question which will arise now is, what do you mean by the term actual cost? Is the term actual cost also defined? As you can see on the board, yes, it is defined under section 43 subsection 1 as what? How it is defined? Actual cost means actual cost of the asset to the assessee as reduced by that portion which is met by any person or authority. It means the actual cost will include all the cost of the assessee, all the cost that is necessary to put the asset into working condition. So suppose if I buy a TV in my classroom, so what is the actual cost? The TV ka price plus the transportation cost, installation cost, everything that is necessary to put the asset into working condition, that will be called as the cost of asset. Even if I have taken a loan to acquire that asset, so whatever loan I have taken to acquire that asset, till the time the asset is not ready for use, whatever interest I am paying, till the time the asset is not ready for use, whatever interest I am paying, that interest can also be what? Added to the block of asset. Therefore, actual cost will include everything. Now, if some portion is met by some person or authority in the form of subsidy or reimbursement, etc., some kind of help is given by someone to you, then that has to be reduced from the block of asset. Now, one more thing has to be kept in mind over here is, now, if you buy any asset, and if you make a payment for that asset to a person in a day, then you have to make the payment by account pay check, account pay draft, ECS, or such other electronic mode as may be prescribed by the government. So if you make the payment other than these modes, then that expenditure will not form part of actual cost. Example, if you buy a TV for 40,000 rupees and if you buy that TV on cash, So that cash portion will not form part of the actual cost and it will not be added to block of asset. What will be the indirect effect of that? The indirect effect of that will be that you will not get depreciation on that portion. Okay. Now, there is a Supreme Court judgment in the name of landmark judgment, Challapalli Sugar Mills Limited, which held that if you take a loan to start a business, so till the time the business is commenced, whatever interest you are incurring on that loan has to be capitalized to the cost of asset. Once the business has started, you have started to put the asset into use, and after that, whatever interest you are incurring, that will be allowed as a revenue expenditure. So moral of the story is very clear. Till the time the business is not started, or till the time your asset is not into use, it is under construction, till that time, whatever interest is there, you have to put to the cost of asset. After that, that means you will just capitalize like borrowing cost, like you do in India. After that, whatever interest is there, you have to put it in the P&L account. Okay. Now, there is some ICDS also based on this, which says the same thing, that if the expenses are not related to asset, then it should be excluded from the cost of asset. But if the expenses are specifically attributable to the asset, then it should be added to the cost of asset. Because the word cost is very wide. What do you mean by the term actual cost? Actual cost means actual cost. The government could have defined the definition of actual cost as this also. Actual cost means price of the asset. No. The government has not used the word price. The government has used the wider term, which is known as cost. The government has said the cost is a wider term as compared to the word price. Therefore, any expenditure which is not related to asset, exclude. Which is related to asset, include. That is what this ICDS has to say. Now, one more ICDS is there which you need to understand, that is borrowing cost, which is similar to what you do in accounts. That is something which you do in Ind AS FR. Borrowing cost. In borrowing cost, you have heard some technical word like qualifying asset. What do you mean by the term qualifying asset? A qualifying asset means an asset which takes substantial period of time for it to be ready for its intended use. An asset which takes substantial period of time for it to be ready for its intended use is known as what? A qualifying asset. Now listen carefully. If you take a loan specifically for qualifying asset, then you have to capitalize that. Now, if you take loan, general loan, which is not only for qualifying asset, but it is for general business purpose, which includes qualifying asset, then you have to capitalize based on this formula. A into B divided by C. What is A? A is the borrowing cost. Other than this cost, that is other than specific borrowing. What is C? I'll tell C first and then I'll tell B. What is C? C is the total assets, average of total assets in the balance sheet as on the first day and the last day of the previous year. Now, what is B? Because you need to proportionately add back to the cost of asset. You cannot fully add back the borrowing cost to the cost of asset because entire borrowing is not towards what? Towards the qualifying asset. If the entire borrowing is towards qualifying asset like this, then you have to add the entire interest. But if it is not entirely towards qualifying asset, then you have to add proportionate. How much proportionate? A into B divided by C. A, I told you, interest other than specific borrowing. C, average of total asset. Now, what is B? B, there are three options over here. Now, listen, be carefully. Average of qualifying asset on the first day and the last day of the previous year. You take the average of the qualifying asset on the first day of the previous year, on the last day of the previous year, divide by 2. Now, is it necessary that qualifying asset will appear on the first day? It might happen that qualifying asset has started construction in the middle of the year. Then what to do? Then see, in case of qualifying asset does not appear in the balance sheet on the first day, or both. It does not appear on the first day, or it does not appear on the first day also, on the last day also. Say maybe the asset started in the month of May and it completed in the month of December. And in the meanwhile, you have taken a loan and interest, etc., etc. Then how to capitalize? Then you have to take what? Then take half of the cost of qualifying asset. So if the qualifying asset is not on the first day, or if it is not on both the days, first and the last day, then take half. Last. Qualifying asset does not appear on the last day. It means it appears on the first day. In point number 2, it does not appear on the first day. In point number 3, it appears on the first day, but it does not appear on the last day. Then what to do? Then take the average of the first day and the date on which it got completed. And then it will give you point number 3. And then whatever comes the answer, that will be added to the cost of qualifying asset, and that will be the borrowing cost, which will be capitalized. And once the asset is put to use, after that you will get a revenue expenditure under section 36, subsection 1 clause value. Then you will claim as a revenue expenditure. Okay. Once the asset is put to use. Now, coming to some explanations. Some explanations are there, some very important explanations, which we are going to talk about them one by one. Out of that, the first and the second explanation I'm not going to talk today because those are related to capital gains and some other topics and scientific research. I'll be talking about something which is independent today. Some of the explanations I'll be dealing with them later on. Don't worry about it. 100% it will be covered. Don't worry about it. Okay. Therefore, the first explanation which I'm talking. Now, what is this explanation exactly, sir? This is actual cost in certain special cases. In certain special cases, the government has defined actual cost in a special manner and not in a normal manner. The first one, explanation 2. Explanation 2 talks about what? Suppose if somebody gives me a gift or somebody gives me some property in inheritance, then what will be my actual cost? In that case, my actual cost will be the actual cost of the previous owner minus depreciation actually allowed to the previous owner. That will become my actual cost. Okay. So if you get an asset in gift or if you get an asset by inheritance, then in that case, your actual cost will not be 0. In that case, the actual cost will be the actual cost to the previous owner minus depreciation actually allowed to that person. Second, suppose if I sell my asset to someone at a higher price, deliberately at a higher price, the market value of that asset is 2 lakh, but I'm selling at 5 lakh to the other person so that the other person can get higher depreciation. And if the assessing officer identifies that, he will go to joint commissioner and he will tell joint commissioner that I want to compute his FMD and I will compute his actual cost. So in that case, if you sell a asset at a higher price, then the other person will get the higher depreciation. In that case, the AO has been given the power to go and take an approval from joint commissioner and then determine your actual cost. Okay. Next, if Mr. A sells to Mr. B and Mr. B sells to Mr. C and Mr. C sells to Mr. D and then again Mr. D sells to Mr. A to B, B to C, C to D and D to A again, then in that case, if you sell once and then reacquire back the same asset, then in that case, government has said that the actual cost will be the WDV at the time of original transfer. Means WDV at the time when Mr. A has sold to Mr. B, that WDV compared with when Mr. D has sold to Mr. A at that purchase price, whichever is lower will become your actual cost. Next one, listen carefully. I am Mr. A, you are Mr. B. You are using some asset for your business purpose. You are claiming depreciation on that. Now you have sold that to me. You are using that asset. You have sold that to me. Now I am purchasing that asset from you, say for 1 lakh rupees. But the WD of that asset is 70,000. So you are using some asset whose WDV is 70,000. You are using for business and you have sold that for me for 1 lakh. Now I am purchasing from you and I am leasing back to you. So if I am purchasing an asset from you on which you have claimed depreciation and you have given it to me, I have purchased from you and I am leasing back to you. What is the sense of that? In that case, my actual cost will not be actual cost, but it will be the WDV in your hands. That means 70,000 will become my actual cost as per explanation 4A2 section 43.1. Next, if I'm not doing business right now, for example, and if I have a personal plant and machinery, personal furniture, personal say plant and machinery and furniture, and if I bring that into business, then my actual cost will remain actual cost. If there is a personal plant and machinery, personal furniture, if I bring that into business, then my actual cost will remain actual cost. But if I have personal building, which I was using for my private purpose, now I am bringing that to my business. In that case, my actual cost will not remain actual cost, but in that case, my actual cost will be actual cost minus notional depreciation for so many years as per the rate prevailing in the current year. Suppose 2015-16, I bought a personal property, and 2021-22, I am converting that property into a business property. So in that case, actual cost will not remain actual cost. It will be actual cost of 2015-16 minus 2015-16 to 2020-21. Depreciation I have to reduce from the current year's from the actual cost as per the current year's rate, as per the rate of 21-22, and that will become my actual cost. Okay. Explanation 6 and 7 we will be taking up later on with amalgamation. Explanation 8 we have already done. Once the asset is put to use, then after that, if you have taken any loan, then that interest will not be capitalized to the cost of asset. That will go to the revenue account, that is to a P&L account, and you can claim a revenue expenditure under section 36(1)(3). Explanation 9. If you acquire an asset on which there is a GST involvement, then you will not be considering that GST portion in your asset if you have already claimed a credit on that. So if you have claimed an ITC on GST portion, so say if you have bought a laptop on which GST portion you have claimed ITC, so on that claim amount, you have already claimed ITC under GST laws, so you cannot take that on the actual cost and you cannot claim depreciation on that portion. Okay. Next, if you are buying an asset and you have been given some subsidy, grant or reimbursement by the government or by any person or authority, then that subsidy, grant and reimbursement shall not form part of asset. It shall not form part of asset. Similarly, if the government is giving you subsidy, grant or reimbursement not for one asset but for pool of assets, say government is saying we will give you 30 crore rupees subsidy for as many assets as you want to buy. So in that case, you will reduce the subsidy proportionately from all the assets. You will reduce the asset subsidy proportionately from all the assets and not from one single asset. Otherwise, what assessee will do? Assessee will reduce the subsidy from that asset which gives you least depreciation. Say government gives you 30 crore rupees subsidy and you are supposed to buy plant, machinery, furniture and building. I will reduce my subsidy from building and furniture because those are lesser rate depreciated. But the government says that no, you have to reduce from all of them proportionately. Okay. And one last explanation as of now over here is, if a non-resident is doing business outside India and now he wants to do business in India, so he is bringing some asset in India. So if a non-resident brings an asset in India which he was using for business outside India, now he's bringing in India, in that case what will be his actual cost? His actual cost will be the actual cost as reduced by the depreciation over the years. Suppose in 2015-16 he has bought a computer in UK. Now he wants to come to India and use that computer. So you have to take the actual cost of that computer in UK minus depreciation over the years. Whatever will be the remaining amount, that will be the actual cost in India. Okay. Now, before we go ahead, let me ask you one question. That is, if I take a loan from government, say for buying a fixed asset, government is giving a loan to me for buying a fixed asset. Now, later on, if I am not able to repay that loan to the government, so government has waived off that loan. So, what will happen to that? Will that loan amount which is waived off, will that also be reduced from the actual cost, or will that be taxable? The answer is no. Why? First of all, it cannot be reduced from actual cost because in explanation 10, it is not written waiver. What is written in explanation 10 is reimbursement, subsidy and grant. Waiver is not written. Secondly, can it be directly taxed as income? No, it cannot be directly taxed as income because it's not a revenue receipt. It's a capital receipt. What is chargeable under PGBP is revenue receipts and not capital receipt. Therefore, it cannot be charged under what? Under section 28 also. Therefore, now what to do? To charge such things, the government of India has brought the definition of subsidy under section 224 clause 18. Section 2 clause 24 subclause 18, whereby the government has said that now the definition of income will include a lot of things. What? Income will include subsidy, income will include grant, reimbursement, waiver. Listen the word waiver very carefully. This is the reason why this particular amendment came in Finance Act 2015. So now the income will include subsidy is income, grant is income, waiver is income, duty drawback is income, cash incentive is income, concession is income, reimbursement is income, but only and only if it is given by central government, if it is given by state government, if it is given by any authority, if it is given by any statutory body, or if it is given by any agency in cash or kind, it doesn't matter. So the giver has to be these people. If the giver is say ICICI Bank, then it is not taxable because the giver's name is not mentioned over here. If the giver is a Reliance Industry or India Bulls Finance, then it is not taxable because it is not mentioned over here. Be very careful. So if these things are given by these kind of statutory authorities, then only it is taxable. Otherwise, it is not taxable. Now, further, there are some exceptions over here. First, there are 3 exceptions which the government has created. First, if the subsidy grant reimbursement is in relation to fixed asset, then you have to follow the explanation 10 only. That is reduced from the actual cost. Then it will not be income. Second, if the subsidy grant reimbursement is given by central government to a central government funded trust or a state government funded trust, so the giver is central government and the receiver is a central government trust or a state government trust, then in that case, it is not subject to tax. And third one, if the government is giving individual welfare benefits like subsidy on LPG, that is an individual benefit. That is not for any business or profession. So if the government is giving some subsidy to an individual in the form of LPG benefit or some other welfare subsidies to individuals, government gives a lot of subsidies out of their budget allocation. So some allocation might be for some individual benefits. So in that case, that will also not be taxable over here. Okay. So what conclusion we can draw out of it? We can draw a very simple conclusion out of it, and that is if the subsidy is for acquiring fixed asset, then reduced from actual cost. Okay. But if the subsidy is any other, then it will be chargeable under PGBP of IFOS if it is received from whom? These people. If it is received from some other people, then it is not chargeable to that. Okay. If it is a capital receipts, revenue receipts are always chargeable. Yeah. Next, if a waiver is done by a company, as I've told you, then it is not taxable because it's a capital receipt and it is not yet taxable. It is not covered over here. If the government puts over here company, firm, AOPBY, or rather government puts over here a person, which will include all of them, then that will also be taxable. So let's wait for that. As of now, it is not taxable. Okay. Now there is a small ICDS on this also. Nothing great as such. Whatever you have done so far, that is only covered over here. Let me tell you how. Now there are 2 questions which we need to answer. First of all, over here is ICDS 7 government grant. You also have a similar ICDS on this, that is India's on accounting standards in your financial reporting also. So here, the first thing which we are trying to understand is when to recognize government grant. And then we will understand how to recognize government grant. And then we'll see if we have to give refund of the subsidy, then what will be the treatment under the income tax law. Therefore, the first thing which we need to understand that when to recognize government. It should not be recognized until you have a reasonable assurance that you will comply with the condition and the government will also give you the subsidy. Unless and until you receive the subsidy and unless and until you have faith on the other person that they will give you or not subsidy, you don't recognize it. The first thing. Second thing, once you have received the amount, then there is no second thought to delay it. Once you have received the subsidy, then you should not think much. You should recognize it. Okay. Now, how to recognize? It's very simple, something which we have done earlier. If it is in respect of depreciable asset, point number 1 and 3 talks about then reduce from block. If it is in respect of one depreciable asset, reduce from block. If it is from is in respect of lot of depreciable asset, then reduce proportionately from all of them, as I've said you in explanation 10 also. Okay. Next, if it is a compensation, then it will be chargeable in the year in which it is receivable. If it is in relation to non-depreciable asset, then recognize as income. Then recognize it as then recognize it as income over the period during which you complete your obligation. Suppose the government tells you We are giving you 100 crore. You have to use this 100 crore every year to expenditure to do these expenditures. So government has given you 100 crore and government has told you have to buy these things out of this. So the moment you start to buy those things, you will charge to your P&L, and the moment you will start to charge to your P&L, you will also charge your P&L on the credit side by recognizing that as an income. So here it is slightly complicated. It should be recognized over the same period during which the cost of obligation is charged to income. Okay, and then balancing figure, if any, you have to follow the accounting system, that is matching concept. Now, in case you have to give refund, then what would you do? In case of first and third case, what will you do? In case of first and third case, sorry, not fourth. This first and third, if you have to give refund, because you're not complying with the conditions which has been attached by the government, so you have to give the refund. So what you will do now? When you have got the subsidy, what you have done? You have reduced on the block. Now you add it back. It is very simple. You add it back. And what about the rest of the cases? The rest of the cases, you have to see how much subsidy government has given you. Government has given you 100 crore subsidy. Okay. Now, how much you have charged to PNN? Say 50 crore I have already charged to PNN. Now, how much you are supposed to give back to government? Suppose you are supposed to give back to government 70 crore. So, if you have received 100 crore, you have already charged 50 crore to PNN and you have to give back to government 70 crore. Then excess 20 crore is what? Excess 20 crore is what? Is your loss. So, you can charge that loss to PNN. And you can knock off 50 crore from your balancing figure which is there in the balance sheet. It is as simple as that. It is just like accounting system. There is nothing new in this. And fortunately, it is not an important issue for exam. Let me tell you very clearly. Okay. Now, coming to section 32, subsection 2, which talks about unabsorbed depreciation. What is the treatment of unabsorbed depreciation under income tax law? It is treated very specially, unlike the other business losses. First of all, it can be carried forward and set off for infinity. There is no time limit. Secondly, it can be carried forward and set off against any income except salary income. Any income except salary income. Plus, there is no time limit. So, it can be carried forward and set off for infinite number of years, unlike other business losses which can be carried forward only for 8 years or 4 years. Okay. Now, what should be the priority of set off? In your exam, if you have been given a lot of things, then what should be your priority? The first thing which you will set off always against your PGBP income is your current year's depreciation, because that is mandatory to claim as per explanation 5 to section 32(1). Second thing which you will reduce is always brought forward loss, because there is a time limit on that. And the third thing which you will set off is unabsorbed depreciation. There is something written in the bracket. You will understand in 1 or 2 sessions. Don't worry about it. That is a beautiful interlinking done of 2 topics. Don't worry about it. Next, how to compute depreciation in case of amalgamation, demerger, succession. The government says very clearly, in case of amalgamation, demerger and succession, compute depreciation as if no amalgamation, no demerger, no succession has ever taken place. Once you have computed, and then after the computation is done on an assumption that there is no amalgamation, once the amount is there in front of you, now divide both of them. Now divide that amount between both of them. Both of them means the amalgamating company and the amalgamated company, the demerged company and the resulting company. You have to divide between both of them on the basis of number of days the assets are used by both of them. So while computing, assume that there is no amalgamation. But while dividing, you have to bring back the reality, and you have to identify that how many days amalgamating company has used and how many days amalgamated company has used. Now, after the amalgamation is done, all the assets of the amalgamating companies goes to the amalgamated company. All the assets of the demerged company goes to the resulting company. So, later on, what will be the actual cost in the hands of the resulting company? What will be the actual cost in the hands of the amalgamated company? So, that is also defined by the government. So, actual cost in the hands of the amalgamated company will be the opening WDV. Be very careful. Here, there is no loophole by the law. The opening WDV in the hands of the amalgamating company will become the actual cost in the hands of the amalgamated company. This is an additional benefit given by the government of India in case of amalgamation, because government treats amalgamation as a very special case, and there are a lot of benefits given to the amalgamation, which we will see in the chapter of taxation of amalgamation later on in the capital gains. This is one amongst them. You will say this is a dual benefit, sir. There is no dual benefit. The government is giving deliberately the extra benefit in case of amalgamation, because amalgamation has to be encouraged, because amalgamation leads towards synergy benefits across the country. Okay. Next, let us now talk about SLM depreciation. How to compute SLM depreciation and to whom it is available. As I have told you earlier, again I am saying it is available to associates engaged in power generation or power distribution. Only these 2 businesses are covered for the purpose of SLM depreciation. Now, sir, what are the rates of depreciation? Rates of depreciation are same only. Okay, there is nothing changed in that. The same rates for building, plant, machinery, furniture, everything is same. Now, how to compute depreciation? It's very simple. Original cost 1 lakh, 10% rate of depreciation SLM. Depreciation, say for 1 year, will be 10,000 every year. After 10 years, the asset will be closed. So 30,000 is the depreciation, 70,000 is WDV. The question is not this. The question is, what if I sell after 3 years? If I sell after 3 years, say for 50,000, what will happen? If I sell after 3 years for 80,000, what will happen? If I sell after 3 years for 1,20,000, what will happen in those cases? Now listen carefully. If you sell for lower than WDV, then the government says that the difference will be allowed as terminal depreciation. If you sell for more than WDV, then the difference will be considered as deemed income balancing charge. Lower than WDV, it's a loss, terminal depreciation. More than WDV, it's a profit, balancing charge. And if you sell more than WDV and even more than selling price of the asset or more than cost of the asset. So if your WDV is 70,000, your cost is 1 lakh, you are selling for even more than cost. Then the difference between this and the cost will be considered as deemed income under PGBP, because that much deduction you have claimed earlier under PGBP under section 32. And the difference between the selling price and the cost, that is 1 lakh 20 minus 1 lakh, will be considered as capital gains. So if you sell lower than WDV, then terminal depreciation. If you sell more than WDV, then balancing charge. And if you sell more than cost, then balancing charge will be there, and as well as the capital gains will also be there. Now, how to compute capital gains in this case? For that, the government has given a special treatment, special calculation. In case of a power generating assessee, if they sell their assets, how to compute capital gains? Now see, sale consideration is very simple. Here the government has redefined the cost of acquisition. The government has told that here you should not take the actual cost of 1 lakh, but you should take adjusted WDV. Now what is adjusted WDV? Adjusted WDV is the WDV that is 70 lakhs plus balancing charge minus terminal depreciation. If you have already paid tax on balancing charge, add to the cost of acquisition and take an advantage in capital gains. If you have already taken a benefit of terminal depreciation, reduce from the cost of acquisition so that you should not get dual benefit. So that is the reason the government has redefined this cost of acquisition. Because if you are already taking a benefit over here by reducing the terminal depreciation from here, then you have to adjust that terminal depreciation in the cost of acquisition, because otherwise you will get dual benefits. One in what? Capital gains, one in PGBP. That is the reason you have to redefine this cost of acquisition, and that cost of acquisition will become your cost over here, and that will be compared with sale consideration, and then after that whatever amount will come, that will be considered as your capital gain. So here you have to work a lot. You have to work a lot on what part? On the cost of acquisition part. You have to adjust the WDV with what? With your cost of acquisition. You have to adjust your WDV with what? Balancing charge and terminal depreciation, as the case may be in your question. And then only you can compute. You cannot directly compute 1 lakh 20 minus 1 lakh, 70 minus 1 lakh, or 80 minus 1 lakh. The sale price is here, the selling price is here, the cost is 1 lakh. You cannot do that. The cost is not 1 lakh. The cost has to be readjusted over here as per this particular section, as per section 50A. Okay. Now if I go for SLM basis, let me tell you very clearly. If I opt, is this an option or is it mandatory? Is this option or mandatory? It is optional. It is not mandatory. It is optional. You can go for WDV also. Now, if you opt this option of SLM, you will not get additional depreciation. You will only get the normal depreciation. If you want normal depreciation, you have to opt the Blockwala method. You should go for block of method. If you go for block of asset, you will get the depreciation as per what? As per normal depreciation, as well as additional depreciation, even for power generating assessee. But if a power generating assessee opt for SLM, then he will not get the additional depreciation. That is what the government has to see over here. Okay. Next. Now, generally in the year of sale, you do not get any depreciation. Let me tell you. Even if you acquire the asset and sell on 31st of March, that is on the last day, you will not get any depreciation in that year. Generally. But there are two exceptions where you get the depreciation in the year of sale. One is amalgamation. In case of amalgamation, in the year of amalgamation, the amalgamating company is selling the assets, still it is getting the proportionate depreciation, if you remember. And second exception is the terminal depreciation, whereby you are getting the depreciation in the year of sale in the form of terminal depreciation. These are the only two exceptions where you get the depreciation in the year of sale also. There is no third exception. Apart from that, in the entire income tax law, wherever you are selling any asset, you will not get depreciation in the year of sale. And one last thing over here is, listen carefully, section 43A. Now it's a very important section. What is section 43A? Listen carefully. If you import an asset from outside India, and if there is a foreign currency loan on that, if you import an asset, condition number 1, when section 43A is applicable, it's an important section for your exam. When section 43A is applicable, 43A is applicable if you import an asset. If it is bought from local market, 43A is not applicable. Second condition, there has to be a foreign currency loan or a foreign creditor on which there is a foreign currency payment. So whatever foreign currency gain or loss is coming on the date of payment, not on balance sheet date. On the date of payment, on actual payment, on payment basis, not on accrual basis. Whatever gain or loss is coming on the date of payment has to be adjusted to the WDV of the asset. Say for example, you have bought an asset of $1 lakh today, on which there is a loan of $1 lakh, and you have not made any payment in the current year. Don't make any adjustment. You have made payment in the next year. At that time, see what is the currency exchange rate, and then see how much gain or loss is coming. If gain is coming, then you have to adjust in the WDV. If loss is coming, then you have to adjust. If gain is coming, reduce from the block. If loss is coming, that is an extra cost for you, add to the block and claim depreciation on that. So you have to make that adjustment on the date of payment. Be very careful. And then there is a very small ICDS over here, nothing great as such, which talks about what? How to recognize foreign exchange rates under income tax law. How to recognize foreign exchange gains and loss under income tax law. It says, first of all, you should recognize as per the transaction date. Suppose today the transaction is happening, to recognize as per today's rate. Then you have an option later on that you can also take what? An average rate of a week. But if there is a lot of fluctuations in the entire week, then you should not do that. You can also take an average rate of the week. You need not take today's date. That's all fine. Then what has to be done on the last day of the previous step? For monetary items, you have to reconvert. But for non-monetary items, you don't have to change. Exactly like income tax, like your accounting standards, borrowing cost. Your effect of changes in foreign exchange rates. Sorry. Now listen carefully. 43A is a very small section which talks about a very specific category of gain or loss. That is, you have to buy the asset from outside India, and you also have to take a loan on that asset in foreign currency, or it should be having a foreign creditor with a foreign currency payment, and then the payment has to be adjusted. Gain or loss has to be adjusted on the date of payment. Now the question is, what about other foreign currency gain and losses? What about if I buy some goods in foreign currency and there is a gain or loss? What about if I purchase some goods and there is a gain or loss? What about if I buy a property or an asset from India and then there is a foreign currency loan? That cannot get covered in 43A because 43A talks about importing an asset. What about if I buy an asset from Tamil Nadu, Chennai, or for that matter from Thiruvananthapuram, and I have a foreign currency loan? What about my forward contracts? What about if I have a foreign branch to which I am translating it into India because I have to merge that with my balance sheet? In that occasion, there is some loss or there is some gain. What about that? What has to be done in that case? The law is very silent. The law is talking only about one thing: imported asset, foreign currency loan. Then only 43A is applicable. Other cases, the law doesn't say anything. And for that matter, 3 years before, the government of India has brought a new section 43AA, which says that here all other gain and loss other than 43A will come over here. And you should recognize the gain or loss as income or loss as per ICDS 6. And here you have to do as per accounting system. You have to reinstate the gain or loss on 31st of March. Here you do the calculation on payment basis, not on 31st March. But here you have to reinstate the gain or loss on what? On an accounting system basis. That is on 31st March. Suppose if you buy some goods today, then you recognize today. On 31st March, you have to revalue gain or loss. And then on actual settlement, you have to again revalue the things and recognize loss or gain in your books of accounts and in your tax purpose. So balancing figure, whatever doesn't come over here will come over here. Now listen carefully. This is the universe, yeah. This is the universe. There are a lot of things which will come over here apart from this. Examples of gain or loss under this section. Monetary item, non-monetary item, everything has to be adjusted. Translation of financial statement of foreign operations. Forward contract has to be foreign currency translation reserve. These are some of the examples given by the government of India which will get adjusted over here. For the purpose of what? Recognizing gain or loss as income or expenditure under the income tax law. I hope it is clear to all of you. This completes your discussion of depreciation, and which is one of the biggest discussion in the chapter of what? In the chapter of PGBP. Now let me tell you, I am stopping the lecture here. Let me tell you, these things which I have revised over here in around approximately 1 hour, 10 minutes, around 70 minutes. This much I take around 6 lectures of 3 hours each to complete in my regular batch. So in my regular batch, this content which we have revised in just approximately slightly more than 1 hour, this will take approximately 15 to 18 hours to complete in my regular batch with great discussion. So my objective is to teach you with great detail, to give you conceptual knowledge, so that the toughest of the paper which comes in the exam, you will be able to solve it. But unfortunately, I don't have any batch for November 22 and May 22. My batches will start for May 23. I only have Hindi English batch, which I have been taking for last 10 years. So now I thought of even passing the benefit to the students of southern part of India who struggles in understanding Hindi. So I'm just giving you a brief about how we do the subject. We do the subject with in-depth knowledge so that the toughest of the paper a student can solve. The student will not be blank in the exam center if the examiner gives you a very tough paper. Secondly, we try to give you conceptual knowledge from every possible angle in the classroom, and then we also try to recap that in an hour. Say 15 to 20 hours job will be done in an hour's time. That is something which the magic is. Because on the day of exam, what will be helping you is definitely the conceptual knowledge which you have taken in class, along with the techniques to revise the entire subject the day before exam. Okay. So with that note, thank you very much. God bless you all. I'll try to upload the videos as soon as possible for you all, so that maximum students get benefited because of this. And I have done this only on the request of the students. Personally, don't like speaking too much English. I am a Hindi spoken person because I stay in Mumbai. So here most of the time we speak Hindi, and our Hindi is also very different as compared to the rest of the part of India. But still there are a lot of requests which were coming from student side. Some of them were saying that in your existing video of Hindi itself, sir, please try to put subtitle. Then I thought that that is not a correct way to learn. If I have to give something to you all, I'll give best, or else I will not. The way I've been doing for the last 10 years. Till the time my mind was ready, not ready. I was not ready to get into the English version. But now my mind is ready. And I feel that I can do it. And that is the reason I have time now, because I've started with my own venture earlier. In my earlier venture, I used to not get much time because I used to take a lot of face-to-face batches in Mumbai. Now face-to-face batches are almost not there in Mumbai since last 2 years. So I've got time. So I thought of giving this particular benefit to my South India students also, who wish to learn the entire direct tax in English also, and who wish to, as of now, revise the entire direct tax in English also. And I hope I have done a good job. My English was decent enough to understand to you all. My message should be conveyed to you all. That is more important. My language may not be that clear as you might be speaking about, as you might be thinking about. But still, I tried my best to give you the best of the thing that I could do. So, with that note, if you like the lecture, spread it amongst your friends across your circle of CA circle. Spread it amongst most of the students that you can. Try to give these benefits to thousands of students across India. Thank you very much. God bless you all. Take care. Signing off. Take care all.